All right, everybody. We are live on Friday again. Welcome to everybody. This is going to be a good one. I know it. And the question that I'm asked all the time, every day, is how's the market? So we're going to talk about, are we heading downhill right now in our market? We've talked about this before on my live streams that as a whole, the overall Phoenix market is in a buyer's market right now. But are we headed downhill? What does that look like? Are we headed for a crash? And before I bring on my guest, which some of you probably already know who she is, but I want to know, where are you watching from? So let me know where you're watching from, because that's always helpful. But we have the best person in the world to talk about all of this with, because it is the one and only Tina Tamboer. And before I bring her on, I just want you to know, Tina, I'm going to say this in front of you. She is funny. Like, she is wicked smart, but Tina is also very, very funny. So don't let the smartness fool you, because she is very funny. So welcome, Tina. Thank you for being here.
Thank you. Thanks for having me on.
Thank
you for telling me I'm funny.
You are funny. You're funny. I know. I'll be in Zooms with Tina, and we all have to be muted, right? And I'll try to send her an LOL every once in a while, because I know she appreciates that. Because she'll make
I do.
Yeah.
It's hard to know if your jokes are funny when you're just talking into a camera. Like, are you guys out there?
Right. It's very funny. So I want to bring up, first of all, I'm going to bring this up because now, you can tell me when I bring this up. We're on the Cromford Report. This right here. Did you write this? I know. So Tina writes this, and so does Michael.
Mostly Michael.
Okay.
I would rather talk for an hour and a half to a camera than write 4 sentences.
Right. I know. So welcome from Missoula, Montana. We're going to be talking a lot of stuff about Arizona specifically, but hang with us, because I'm sure that some of this is going to translate. And if we can help you, let us know. Okay. So I'm going to go back to this, because this is something that I have seen kind of more and more and more. And I'm going to pause just even for a second, because if all the people that are watching this, I know you guys watch a lot of YouTube, and if you watch anything about the housing market, you are inundated with the market is crashing. But you've also been inundated with that for probably about 5 years, because everybody has said that the market's crashing for probably 5 years or more. So we're going to kind of get into that. And I know that one of the other big topics right now is foreclosures. And I thought this was very interesting when I read this the other day. So this was March 21st. And please note dates, because if you're watching this not live, make sure you're noting that this is these are date specific. So March 21st says the number of foreclosures pending in Maricopa County is very slowly creeping back towards the level it was in 2020 before the pandemic. The number started at 870 at the beginning of last year. It reached 1206 by the end of December and is currently around 1300. While this is still low by long-term standards, we are now at the highest level since mid-2020, and the trends suggest we will reach between 1,500 and 1,700 by the end of the year. You can view these numbers, and we'll get in there. Before anyone who started real estate after 2020 starts to panic, the lowest numbers we saw before the pandemic was 1,800, and during the worst of the foreclosure wave in 2009, we had over 50,000. That is drastic. So let's look at this.
Its perspective is key.
Massive, right? So this is that chart. So this is showing. Can you see it?
No.
Sorry. Let me. Sorry. This is where. Okay. Here we go.
It's a little funny.
Here we go. Let's see. If not, let me do this. You start sharing this again.
Yeah. So when you put it in perspective, like that, maybe the numbers don't quite feel right. If you're a visual person like I am, you really have to see it. And when you see it, you realize this is not really a big deal at all.
Well, right. So this is that chart. And it looks, again, when you look at it in perspective from 2020 to now, it could look a little scarier, right?
It could, but if you were to, and I don't know if you can do this, but if you can switch it over to under your Tableau charts, under that foreclosure one, you can get a longer term one that doesn't.
But I like to just do this.
You can definitely see it that way. where it's really not significant
Right.
at
That's,
all.
yeah.
It's a non-thing, but it will be opportunity for some people who are looking for some form of opportunity in purchasing foreclosure. Now, just because you get a foreclosure doesn't necessarily mean you're getting well below market value.
Right.
This is not that kind of marketplace. We're seeing when we dig into the actual numbers, we can tie some of these foreclosures and short sales back to people who got caught up in 2022 as short-term flip investors many times, where they bought on the high, then they got caught when the Federal Reserve started raising their interest rates and everything the water got turned off, and they held on to the properties for like 3 years trying to see if the values will come up. But if you have one of those loans that's a hard money loan, many of those loans may be coming due and you're forced to sell. And if you can't sell it, then you may be forced to go into foreclosure.
Yeah.
And so you're seeing a little bit of that, but we're also just getting back to pre-pandemic. If you remember, so many people went into forbearance that we've been at such low numbers. And in fact, we were foreclosing more properties back in the 90s and the early 2000s than we are today. And we're significantly larger. So we don't expect the foreclosure stuff. It's an interesting data point because we get asked about it a lot, but it's really not, it's not going to be a significant effect on our prices at all.
Yeah. And I feel like a lot of people ask about it here because we did get hit so bad in 2008 and 2009, and that wave of foreclosures, and then the short sales came and like all of that. And I feel like people are holding out hope to maybe be able to get that deal again, and that our prices are going to drop like that again. And I mean, I look at the numbers like you do, but I mean, you look at them way more and in much more depth than I do even. But all I see is just kind of a stabilization and maybe a little dip every once in a while.
Well, in order to get that, you need a couple of things, two very specific things. Okay. The very first thing is you need a desperate seller. I mean, a seller that has literally no other choice. They are underwater, meaning that they owe more than their property's worth, that, and they can't afford it. They've lost their job, which is essentially what kind of happened. And you would also need to see an absolute collapse of the lending industry.
Well,
we don't expect to see that. I mean, imagine this: if you have your home up for sale, you're in foreclosure, you're losing your job, all of that stuff that was happening in 2008. And then you find out that only a cash buyer can buy your home because the lenders can't lend any longer.
Right.
And then that's when you're going to see property values absolutely plummet because you just don't have the lending. We're not expecting that. Our lending community is so strong. The loans that they put out are not in default for the most part. Certainly not to the level that we saw back then. And the ones that might be in default actually do have equity. So even if the bank takes their home back, guess what? They actually get money when the bank sells that property. If they sell it for more than what is owed, they are required to give it to the previous owner. Yeah. So there's just so much today that is not in effect. And then one last thing too, if you guys remember that back in 2008, 5, 6, 7, and 8 for that matter, we saw rents were much, much, much lower than payments. That is actually not the case right now. Right. So why would anybody allow their property go into foreclosure if they literally are making a $1,500 payment on a $2,500 square foot home? You cannot rent that for what you're paying on it. So there's really very little incentive for what we used to call the strategic default back during the foreclosure crisis, where people are like, well, I can go rent the same thing for $1,000 less. I may as well just let it go. And that's what they did. But they're not doing that now because where are they going to go?
Yeah, no, rent. I mean, I've seen, and I know you probably have too, but I mean, I've seen rent softening, but it's still expensive.
Yeah, it's not softening to compete with a sub 3% mortgage payment right now that many, many people have.
Well, and that's the other debate, right? It's like, is it should I rent or should I buy right now? And I think I was listening to somebody else explain this, and they said, if you are thinking that you're not going to be in the house for more than 3 years, then rent.
Yes.
But if you're going to be in the house for, 7, 10 years, then I would buy. The interest rate doesn't really matter, because over the long haul, right, at any 10-year span, from the time that you bought it to the 10 years after that, the appreciation has always gone up.
True. Has not always gone up to the degree that we've seen it over the last 5 years, though.
Nothing,
so
right?
I think
That's
a
an
reasonable
anomaly.
expectation would be 3 to 5 years average over time. But in the current environment that we have right now, the strategy would be to hold for 3 to 5 years, to hold it through this period of time. And my other piece of advice is buy the home and then get off Zillow. Do not check one more property. Don't be tracking prices for, another couple of years. Just enjoy the home.
Yeah.
And if the mortgage rates come down, you're not going to care what you paid for it, because you're going to probably, lop off some money off of your payment anyhow if a mortgage rate drops. So I'd say, just go get the home you like. This is the environment that buyers like, where sellers are, the homes are in great condition. The sellers are rolling out the red carpet. I mean, buyers are coming in homes like right now, like they're food critics.
Yeah.
Sellers are having to serve them like, how do you like this home? And they're like, I don't know. It has this funny smell.
You
I
said
like that wall over there.
You said something the other day. It was so dang funny. You said when sellers say, I'm gonna really clean up my home, or what did you say? Something about really
sell it as is,
or something like that. And you said, you better, make sure if you clean it, like make sure you got to do more than clean it.
I think what you're thinking of was when I said a lot of times people know that their properties are not perfect, and they're like, I'm just going to price it aggressively. And I'm like, as long as you clean it aggressively too.
Yes, that was what it was. Yeah.
Because the idea of selling as is in this marketplace, it means that your is needs to be good, like excellent.
It does. And that's the thing, right? So in that conversation of where is our market going? Overall Phoenix is in a buyer's market, and I'm going to pull this back up here. But we're in a overall buyer's market. However, not everything is in a buyer's market. So here is our top 17 cities, and you can see, let me see if I can shrink this. I don't think I can.
Just to be clear, on the Cromford Market Index, once you get over 110, you're considered a seller's market. Below 90 is considered a buyer's market. And what that means for price is we expect you to be able to achieve better than the rate of inflation if you're in a seller's market for a year-over-year appreciation rate. Not from here forward, from here backwards, right? So if you are below 90, then compared to last year, your price appreciation is going to make it be very difficult to get that up above the rate of inflation. So most of our price ranges, even if we're in seller markets, because these are very weak seller markets, frankly, and they're continuing to weak. If you'll notice the red circles there, they're not getting stronger. And so you're getting very little in some cases, just barely above the rate of inflation, which is like 2.5%.
Right.
So,
and I think that's the big thing too, right? Because some sellers are still out there thinking, oh no, it's a seller's market and I have a great house and it's all updated and it's everything. I'm going to get multiple offers. And you might, depending on where it's located, but you might not get 12 offers. You're probably not going to get $200,000 over your list price.
If you underprice it and you're in excellent condition, you will get multiple offers.
Right.
But gone is the day where you can be a less than perfect home and get on the market and sell within a matter of minutes. That is a crack cocaine seller's market. We're no longer in that crack cocaine market. No. So a regular old everyday seller's market means that you have some mild upward pressure on price that the sellers can, and there always are, pushing up on the upper boundaries of price in the market. And in this market, because we have so much more supply for the buyers to choose from, they are handing the sellers their hat. And the sellers are getting forced to reduce their price and come back down to where the buyers believe their market value is. But here's the deal. We have now 23,000 listings in the MLS. That is a normal level of supply for this time of year. We just haven't seen it for 10 years.
Right.
But we are, being paired with demand that is 20% below normal for this time of year. So we don't have enough demand, even though we are at good demand equal to this time last year. We're not declining in demand. Just so many sellers have gotten off the fence and thrown their home on the market that the buyers just have a plethora of choice. So if you're in a subdivision and you've got 4 other floor plans that are exactly like yours and your home has character, then you might lose a buyer over a accent wall because they don't want to do not one thing.
No, they don't. And it's like all you have to do is paint it. They're like, yeah, I don't like it. I don't like it. I don't like how it feels. I'm not kidding. The things that I see, the things that I saw buyers okay with during the pandemic that they're no longer okay with is so drastic right now.
Right. Oh yeah. They don't even want to do a repair list. If they think that there's too much to be done, there's too much deferred maintenance, they'll just go down the street and try to find that property. So this is the effects of being in, and I want to be clear, this is not a 2006 through 2008 buyer's market. This is not the granddaddy of them all. That was extreme. This is a regular old everyday buyer's market. But when you are in a buyer's market for a prolonged period of time, not like 2022 when we had it for 4 weeks.
Right.
2022, we had a 4-week long buyer market. Didn't have a whole lot of effect. And in 2010, we had about a 4 to 6 month buyer market. But we're not like 2010 either. This buyer's market has only been the last 4 out of 5 months, but buyer leaning, balanced market, but leaning towards buyers. We have been in that kind of situation now for going on 7 months. So you have to be in a buyer's market for a significant amount of time to see any significant reaction on price. And the reason for that is the first stage of a buyer's market is convincing the sellers that it's a buyer's market,
which is a challenge.
Yeah. And they have to go through the stages. And even the buyers may not know that the market's leaning towards them in the beginning. It starts out with, okay, I'm going to give you over asking price, but I need some repairs. And the seller says yes. And they're like,
right.
What?
Like,
we're getting repairs now? Next thing you know, they're like, okay, I'm going to go over asking price. I'm going to ask for repairs and concessions. And the sellers say yes. They're like, Then you ask for full price with concessions and repairs. Then it goes on and on to where they're skimming a little bit off the top. And now after 7 months, we are getting the stage where the buyers want it all. They want the perfect property. They want the perfect condition. They want to have the concessions, and they're going to still kick you in the gut on the price. And so by having that perfect home that you've maintained and decorated perfectly and been so meticulous with, your reward is actually getting the contract.
Right.
And unfortunately, you still won't get your asking price, but you will get the contract. That is what you're going for. It's not, hey, I'm going to be able to sell for more than my neighbor. No, you're going to sell it all.
Yeah. Well, and so I want to go back to the demand part, because this is kind of a philosophy that I have, and tell me what you think about it, because I know from me, I have a lot of buyers that are wanting to buy and they're ready to buy. But the only way that you can really measure demand is when we get a contract.
Yes. If they're like the essence of demand.
Right. So I feel like
they actually write something up.
I always go like, okay, but we do have demand, like, because there are buyers that are ready, willing, and able to buy, but they're being really picky. And therefore it's taking them a lot longer to buy. And so I look at that demand and I go, okay, I get it. That's what the number's showing, but I know, because I'm in the market every day, that I have buyers that really want to buy, but again, they're being picky. So they're just waiting, and they're not waiting because of the interest rate. They're not waiting. They're just, it's the house. That's
right. They probably get caught in the weeds a little bit because there's so much more coming on the market. There's always another home that comes on the market. So if you get one that's not quite perfect, you're like, oh, I'll wait for that perfect home. Well, my advice would be, though, I wouldn't wait for the rates to come down, because what happens is once those rates come down, then those people circling start biting. And then the property that hit 99% of your likes, but was missing that one little thing, somebody else is going to pick it up, and you may not get another listing that looks just like that. And if you do, the next thing you know, you're finding yourself competing for it.
What is interesting, I had a conversation with somebody at a new home construction sales office not long ago. And we were talking about the interest rates and the whole thing. I said, you guys are kind of beating some resale because you're able to do rate buy downs and things like that. So for new home construction, for some people, it just makes sense if they don't have to move within a certain amount of time. They can wait. They can do all those things. And she said, no, you're right. And I said, and you guys have some incentives. She said, you're right. She's like, but all of our people at the top, they are all waiting for rates to come down. She's like, and as soon as they hit a certain level, every incentive, every rate buy down, everything is gone.
Correct. And so that's why, buyers markets are funny because buyers are waiting for buyers markets. Then you hit a buyer's market and they're like, I don't really feel like it.
I'm going to wait and see how much farther it goes.
What if it goes down more? So the irony of the whole thing, this was a survey that was done with the builders, the National Association of Home Builders. And one of the top two concerns for home builders was people waiting for prices to come down or mortgage rates to come down. And ironically enough, the last time it was elevated to this level, well, not quite to this level, just elevated in general, was 2011. Do you know in 2011, you could get a house for less than it cost to buy a car? It was the bottom of price. It was like, oh, a house is $1. Maybe it'll go down more.
Right. Maybe it'll go
really? Right. And so will prices come down? Is there a risk of prices declining right now? Yes. Yes, there is. Here's the interesting thing. You never know you're at the bottom when you're there. That's why we have the Cromford Market Index. We can tell you we're probably not at the bottom, but I can also say that we're not seeing a whole lot of movement on prices on the downside. There are some segments are and some segments are not. So you really have to know the area you're in, the price ranges that you're in to see if prices are gliding down. Areas in the outskirts of town, such as Buckeye right now or Maricopa, those outskirts where all the builders are building, those are in buyers markets. They are the first ones to go in the buyers markets and the last ones to come out. Oftentimes we don't actually see the prices come down because they are giving so much on the incentive underneath that line that you just don't see it. So if you're waiting for the price to come down, like you said, once those rates start coming down with it, then all of those incentives go away. And ironically, you might be paying more. Right. And it's, I'm not going to pretend to know how long this buyer's market is going to last. But I can tell you with some confidence that when the rates do come down, and they don't have to come down a lot, here's a reference for you. With every 1% that rate drops right now, expect a 10% off your principal and interest payment. So
which is pretty significant.
Yeah. So if you're looking at a loan right now, it would be $2,500 a month in P&I. If that comes down 1%, you're going to get $250 off that. Mm-hmm. That's pretty significant for a lot of people to get off the fence. So with a 0.5 point drop, you get 5% off, which is still over $100. So with that, what you're going to see is more and more people kind of get in, and you might find yourself really at 6.1 even, we would see a significant bump. We already saw that in September of last year when the rates went down to 6.1 and hung there for about 3 or 4 weeks. Mm-hmm. We saw a 13% increase in the month of October, which is one of our lowest months for demand. And it was boom. It was almost immediate.
Yeah. I remember that.
That all those the nicest properties will go first.
Mm-hmm. Yeah. So Timothy Casey says a home loan 30-year, home loan 30-year, year loans at 7 to 8%.
Yeah. That's why he was believing that was because of why the people weren't jumping so much. But again, currently they're at about 6.8 on average. Right. It really depends on your area. Always talk with your lender for the record, because it does vary by area. But we have plenty of hacks in the housing industry for high mortgage rates. I mean, nearly everything, well over 60% of sales between 300 and 600,000 here in the greater Phoenix area include some form of rate buy down. Temporary, permanent. Yeah. The sellers are giving a median of $10,000 to pay off closing costs and buy down rates. So the rate issue is something that we've been maneuvering for a while, but the buyers still have to qualify at the higher rate. So there's that.
Right. And I mean, I talked to Matt, who last week about that.
Mm-hmm.
And it's that rate buy down is a great tool. The rate buy down, like the 2-1 buy down, it's a great tool. But even he said, he's like, there are people that I did this with 2 years ago, hoping that the rate would change, and it hasn't. So it's a risk that you run. You just have to know going in that if it doesn't change, that you can afford that shift in price.
Yes. And, I know some of my family members who got that as well.
Mm-hmm.
And the good news is my niece, who's in her 20s, she says, that's okay. I've had a couple of raises since then. So she's in better position. She's not really, but you're still, the minute that drops down, you're going to do a refinance.
Right. Of course. Right. And that I always tell people, I'm like, you need to stay in touch with the lender. Because if you see a drop in interest rate, it might, even if it's 0.5%, like I would still call them and have them run the numbers and see if it makes sense.
Yeah, it could be. Yeah, possibly.
You know?
But I mean, that's just kind of the word of, rule of thumb, and just knowing that when prices are flat like they are right now, unlike back in 2020 and 2021,
Mm-hmm.
when prices were rising so fast that as the rates were dropping, it didn't have any effect on your mortgage rate because they offset each other. This time the prices are flat. Every little fluctuation in that mortgage rate has an immediate effect on somebody's ability to qualify or not qualify.
Mm-hmm. Mm-hmm. I want to share this part of the, this is part of this was on March 18th.
Mm-hmm.
It says the reason that active listing prices have declined so early in the year is that there are too many of them. The chart below shows weekly readings for the past several years in 2025 is
Correct.
in red. Sorry. I just want to read the bottom.
Or the top one.
Yeah. In 2021, 2022, and 2023, active listing counts dropped after the first couple of weeks of the year. In 2024, saw them grow steadily, but 2025 has seen them ramp up much more quickly, rising from 20,000 to nearly 25,000 after 11 weeks. These listings are offering lots of choice to the buyers and giving sellers a problem they don't need. Right now, there is no sign of the trend coming to an end. While demand has improved a little since the start of the year, there's nowhere near the level needed to absorb this amount of inventory. So again, I mean, this is kind of what our active inventory looks like, which is, and I talk about this a lot on the channel with these charts, is that contract ratio. And so it's just that the homes are not coming off the market as fast. So it brings that contract ratio down.
That's right. So I just want to stress, though, that when people see lines like this, they start to have PTSD.
Yeah.
And, I want to remind people, before the crash of 2008, in November of 2007, we peaked in supply. And that number was 57,000 listings in the MLS. Okay. We are nowhere remotely close to that. We only had 4,000 listings in escrow waiting to close. So 57,000 active listings, only 4,000 in escrow. That was literally before everything collapsed. We're in what I would call a regular old normal buyer's market. It's gone on a little bit longer. And so now we are at a stage where we might start seeing prices decline, but it is not going to be a double black diamond ski slope. It's a glide. It's just a glide. Where you see it is in the negotiations. So we have a chart called list price versus sales price. And you can see from the last list price, what is the average negotiation? Are they getting 98.5% of your last list price? Are they getting 77? What was it last year? So what you're seeing is a slight decline from last year to this year. And you can see that they're just shaving a few extra $1,000 off than they would have last year. So say, for instance, maybe last year you would have seen a price negotiation and they would have shaved off $5,000 to $7,000 off your last list price.
Here,
now,
that up.
So if you click on the sales price to list price ratio tab in the upper left, that's the one I'm talking about, where he says 97.6. And if you go to March of last year, it'll be, I think it's like 97 well, that's 2023. So
sorry.
it's not that far back. There you go. You just passed it. But basically you can see the message is that it's coming down. So 97.9 down to 97.6. So, you know,
It's just been jagged right here.
Because Christmas,
Yeah.
you always get the biggest, all of those dips, most of those dips are seasonally. November and December are when you see the strongest negotiations on price because people want to sell before the end of the year, especially builders. So you often see that mad push at the end and everyone's like, fine, I'll take what you have. It's the slowest time of year. It's the best time to be a buyer is the fourth quarter, frankly. And so you see those little dips and then you bounce back up in January. But what we're looking at, I always look from year over year. What you're seeing is those buyers are just shaving off a few extra. So they're getting the perfect house and everything. And then they're like, sellers thinking, all right, I'll negotiate down $7,000 or $8,000. And they find themselves accepting $10,000 less.
Right.
You know, and that becomes consistent because everything else now is equal. We've been doing concessions for 2 years, 2.5 years now. Concessions have been part of our lives. And really that is a given in a lot of, it doesn't make you special anymore. So over time, you know, the things that make you special are less and less because you have more and more competition that's just like you. And with all things being equal, they're going to pick you and then they're going to lop a little off the top.
Well, it's funny what you were saying earlier, as far as like close on your house and stop looking at Zillow. I even had a client more recently. He said, what if I get through my inspection period and I find another house? And I said, yeah, no. And he said, so after we're done with the inspection, I said, stop looking. I said, yeah, stop looking immediately. Immediately.
Exactly.
Like,
don't torture yourself.
Right. You've won. Just let's move on. And you got to stop. And
if
I think
see
that's
it, just make the story that it smells like cat. I'm sure there's something I'm not seeing.
Right. I know. Well, and I think that's the thing too right now with buyers is that for so long we had nothing. You know, there's nothing for them to look at. And now they've got options and they're like, well, I don't want to stop looking. I just want to keep looking at all my options. And I always tell people,
bad dating site.
Yeah. I'm like, when you get in the right house, you are going to know. And they're like, what do you mean? I'm like, I promise you will have a feeling, a visceral feeling. You're like, this is my house. This is my house. You just know.
Yeah. And so like I said, it's, you know, they're going to get a home that is most likely in excellent shape. So the advice for sellers now is if you know you have a roof leak, get it fixed. If you know you're going to need to have anything done, if you think it's going to be on the repair list, just get it done before you list. If you think you have to neutralize, just neutralize before those pictures are taken because somebody will eliminate you from pictures right now.
Yeah.
So, and you'll never know. The market doesn't come out and say, hey, you're overpriced and you have a color I don't like. They don't come out and tell you that unless they actually go and see it. You might get that kind of feedback. But for the most part, they just ghost you.
Totally. And it's funny because like with listings, sellers always want to know what's the feedback? What's the feedback? And I, you know, if I get the feedback, I share it. But here's what I also know. For real estate agents, if they have no clue about the price and their client just didn't like the house, when it asks, what do you think about the price? Every single time they're going to say it was priced above the market. Every time.
Yeah. They're always going to do that.
Right. And so then the sellers are like, oh my gosh, are we overpriced? And you know, if your home is priced really well, and especially right now, because people aren't used to waiting, they're not used to these days on market right now. Right. And so they're like, are we overpriced? I'm like, okay, we just need to be patient. We've looked at all the comps. We've looked at everything. You're priced really well. Right now, we just have to be patient. And you have to know that any agent that comes through and their client didn't like it, if they feel like they've got to fill out these, you know, feedback forms and they say, what do you think about the price? They're just going to tell you that it's overpriced. So I don't give that a lot of weight.
Well, think about it. If their buyer comes back and says, you know what, I think I like that house. And you just told them it was priced well. Now what are you going to do?
Right.
So you always have to come in like, of course it's price because, you know, just in case.
Right. I know.
I don't even know why they put that on there. They should just say that.
I don't know either because every single time it's the house is overpriced. The house is overpriced. Yeah. So I think that I'm going to take this off the screen because I'm flying around in here. So Tina, why don't you go into, I was just going to say, why don't you go into the Cromford Report and pull up some of those charts that you are so great at. And then we can kind of talk about like why you're saying our market is not heading for a crash. Like, we are slowing down. The market has changed. It has kind of shifted towards a buyer. Well, we're in a buyer's market, and in some areas, much more than others. But
Right.
the way I know the Cromford Report pretty well, but I promise you that Michael needs to change these labels. We've talked about this because they're sometimes hard to find. I'm not going to lie.
I know. We are analysts. We are unfortunately not artists.
I know.
But
There's times I'm like, I know this is in here. Where is it when I have to
Yeah.
find something to really prove a point?
So this is my favorite chart right now. This is the Cromford Market Index over time. And so, like we stated, at 100, we're in balance. And when you're in a balanced market, you can expect about the rate of inflation for your appreciation rates. When you go below 190,
Add this
which is
up here because we can't. There we go.
is it up? Oh,
Now it is. Yeah, there we go.
okay. All right. Thank you.
Yeah.
So what I like is it gives us some context. So this market, as you can see, it has glided into a buyer's market and lingered there, but it's not plummeting. It's not like from 2005 all the way down to 2006. The lowest we ever saw on the Cromford Market Index was 26.5. That was November of 07. Like I stated, 57,000 listings in the MLS, 4,000 under contract. That was before the crash. And look what happened when the crash started happening. We actually started to see the recovery. So if you wait for that, you better get on there. The key is to be the first one.
Right.
And so history has told us that appreciation starts after we move back above 110. So right in here is a period of time. It is only the fourth buyer's market we've had in 25 years. It's not plummeting. It is an opportunity, and it could easily turn back up when those mortgage rates come back down, and not back down to 3% or 4%.
No.
More like 6%. We'll probably start to see some movement back towards balance on that. So when we see that, let's look at our charts. So if I pop over, we use a sales price per square foot. I like to use a 3, 6, and 12-month moving average just so you don't get ugly charts. And what you'll see, which might be ironic, is an increase in prices. So that might be something you were not expecting to see, right? So we have a bifurcation in the marketplace right now where we have a lot of luxury selling, and we are restricted under 500,000. So that pushes all of your averages up, which is why we like to do this by price range. So if we're a single family home and we are, oops, let me redo that. I accidentally clicked on the wrong button there. So we're a single family home. I'll get that in a minute. We're going to go to, say, the 300 to 400 range, just below median. See that? Not a lot of movement. Came down a little bit from June of last year, but it's really been quite flat going for all the way from October of 2023 all the way to today. It's like I said, it's not a huge thing. It's gliding. If it's going to come down, it's going to be a glide. So if we go to 400 to 500, again, even a mild uptick on that. And this is across all of our cities right now. It's including everybody. So if we were to go, say, to our Chandler city,
which is our hottest market, has been for 4 years.
Yeah. Hottest market, but yet see still a slight glide down. This is not a catastrophic thing. And if you've owned your home for, say, 4 or 5 years, like maybe you bought it in June of 2019, do you really care about that little dip there? You might have to go through the 5 stages of grief. Like, oh, dang it, I should have sold in June, But for the most part, a lot of people are just fine on that. So we go to 5 to 6, and you can see a little adjustment there. That's what we're talking about. It's a minor adjustment. So when people say we're going to have a crash, what I have a hard time getting from them is, what do you define a crash as being? Because if you talk about a crash to me or to you, we're going to think you think property values are going to drop by 50%.
Right. Well, that's exactly. I mean, when people say, I think the market's going to crash, I'm like, you think like 2008 is going to happen again?
Yeah. And my second question is, why didn't you buy in 2022? Because we could argue that we already had a crash. 2022, there it was. Nobody wanted to buy. Probably because rates were going up. They were not, at that point, they were 5 and 6%. And we thought that was ridiculous.
I know.
Remember, like, who's going to buy a home at 5 to 6%?
Well, we sat there for so long. And that's the thing. I feel like we got, what is it? So John Doe says crash means prices come down approximately 30%. That's a big number.
We don't see it in the numbers. It's not supported. And that's why I go to the Cromford Market Index. The Cromford Market Index is not supporting a 30% drop in price. Now, it did support when it was, if you remember, coming back over here, remember this from February of 2022 all the way down to here? That was a very strong correction. And we stated that it was probably going to be about 10 to 15%. And we had about 12 to 13% correction between June and December. And then it stopped on a dime. We hit a buyer's market. We lasted 4 weeks and then we bounced.
I remember
back
that.
into a seller's market.
We hit that. We flew through that buyer's market so fast that nobody knew we were in it until we were out of it.
That's right. That's right. And that's why we said you have to be in it for a while, but we did see a correction. And most of the people who suffered through that would be the short-term hold flip investors. They were the ones that got caught holding the properties. Most of the people that bought in there probably still have their home, and they probably have it at a 5% mortgage rate, frankly. So they may not be
in the grand scheme of things right now, if you had 5%, that's not terrible.
Oh, that would be amazing at this point if we had 5%.
Right. Well, so here's a question, because I get, I talk to a lot of real estate agents from other cities, and they obviously don't have the Cromford Report, which I'm so grateful that we have, because it gives such amazing information. And they always say buyer's market, seller's market, six months on inventory, less than 6 months inventory. What, from your perspective, like how, I just don't feel like that's a very good data point.
It tends to be very seasonal.
Yeah.
It's a very seasonal data point because we tend to see, our seasons, our peak buyer season is right about now. So we're going to have a high level of sales. And of course, you're going to see sometimes our supply is dropping, and you'll see that change. And then boom, overnight, it goes back to, summertime, where you see lower sales volumes and things like that. It's just really not a very consistent number to make decisions on. So that's why we use the Cromford Market Index, which is seasonally adjusted. But we also have a way to look at the seasonality across the valley, so that you can see the heat, if you will. The contract ratio is not seasonal, so you can see what the seasons look like. So if I were to share that screen with you real quick, I'll show you what that.
Well, you're pulling that up. We're going to talk about. So John Doe came back and said, I heard a lot about demand sidelined, waiting to jump in the market. We simultaneously have record low savings rates and record high consumer credit card debt. Where will the demand come from? So really quickly, I'm going to share something else.
Okay.
Because I pulled this up just in case something like this topic came up. Because I think and Tina, you talk about this sometimes. I think this is an interesting thing to see.
Oh, yes. The migration.
Yeah, this is where people are coming from, and how much, where are the people coming from, and who's coming here, what age groups. I mean, it tells you a lot of information. So this is where the majority of ours are coming from retirement.
Well, I would say right now, I would say that's where our population has been coming from for some time. But as far as where the buyer demand is, buyers in the retirement communities do not like inflation. They're mostly cash, so they don't really care about mortgage rates. So that's not an issue for them. They're about 40% cash. But they, when inflation goes up, even though it's flattening out, we've had 3 lackadaisical years of retirement demand, meaning that, so eggs go from $2 to $10 a dozen, right? And then it stays at $10 a dozen for 2 years. And we're like, look, inflation is 0. And they're like, but eggs are still $10 and I'm pissed off. And so that's the retirement communities. When you see inflation not under control, they tend to hoard their cash. They don't want to put in, buy a house and, not have the cash just in case. But where we're getting most of our demand right now is in luxury. So if you've noticed, luxury does not care about mortgage rates at all. They are all about their portfolios. So at this point, we have seen the stock market over the last year go up significantly, along with cryptocurrencies that actually peaked right around December, January this year as well. We had a phenomenal first quarter. So we're seeing plenty of people with plenty of money buying homes right now. We're having probably the best year ever, over $1 million, which is unusual. But I will tell you that with fluctuations in the stock market, we could definitely see them take a pause. They don't like volatility in the stock market.
No. So John also says, per the Census Bureau, which is Tina's favorite subject, just gonna warn you, she loves the Census Bureau. Per the Census Bureau, if we remove international immigration, Maricopa County saw a net negative domestic migration pattern in 2024.
Okay. Well, my first question is, why would you want to remove international immigration? I mean, we've got Taiwan Semiconductor here. They're going to be bringing in quite a few people from. Why are we not going to count them?
We have to.
I mean, they are going to have. We're not talking about people that are undocumented here. We're talking about people who are maybe coming here internationally for work. We have plenty of international buyers that have come out for the semiconductor industry out here. And so, first of all, I would not remove them. Second of all, I'd say the census of 2020 was an absolute dumpster fire. We have this thick apology from the Census Bureau of the year after saying, we're really sorry that our data sucks, but you're going to have to use it for the next 10 years because we're not redoing it. So not only that, but by the time we get their migration stuff, it's like 2 years later. It doesn't really help us out today, unfortunately. I'd say, what kind of income do we expect from semiconductor employees? They're usually upper end. I want to say the last I saw, you're looking at average incomes anywhere from 70 to 90,000. But they're going to have everything from administration all the way up to high-end manufacturing talent and executives as well. So that's just going to be a massive influx of a specific type of employee.
Yeah. And we've talked about this, that 303 employment corridor over there and the housing, everything that's coming over there is massive. And back to your point about the luxury market, that Peoria is now starting to kind of pop up in, before it was always Scottsdale, Paradise Valley, a couple other places. And now Peoria is kind of popping up in that luxury market. Well,
and we're also building spaceships out by Mesa Gateway Airport. Yeah. They got a big spaceship rockets they're going to be building. I don't think they're going to be low income either. Yeah. So we're looking at.
You're welcome, John. Thanks for coming.
One of the things that they rarely discuss in affordability is the fact that people's incomes are actually rising here and across the board as well. So that is not a stagnant number. So as our incomes rise, if those rates come down, and of course the home values remain stable, we could actually see eventually those affordability measures catch up, because like I said, the census is very behind. By the time we get all of that income data, nobody cares anymore. They already know.
What's you always talk about another number that is so incorrect, because it's if they call you and say, hey, what do you think your house would be worth? What would you rent your house for?
You're talking about owner's equivalent rent.
Yes. Another warning. I always like to throw these warnings out to people. Like, when you're reading these things, be aware of what this really means, because a lot of people don't know.
So one of my pet peeves is that when they talk about inflation, oftentimes journalists, and I don't blame them because they're not housing analysts, but many times journalists will say the cost of buying a home has gone up. And of course, that's bleeding into inflation. Inflation takes no account of the cost to purchase a home. That's not, it's like saying Tesla stock went up, so that's in the inflation report. No, you're not going to put the cost of Tesla stock in the inflation report, because it's an asset. When you are buying a home, you're investing in housing. When you are renting a home, you're consuming housing. And as a consumer, you go into the consumer price index. So it's rents. Rent is in the inflation report under housing. And a large portion of the inflation report is not actual rent. It is something called owner's equivalent rent, where they do a poll and they say, hey, if you were to rent your home out, what would you ask for it? And you say blah, blah, blah. And they say, thank you very much. And that is what it is. It's
very inaccurate data.
It's not really They don't even use an automatic valuation model, which you would think just like Zillow will tell you what approximately they think your home is worth. They don't even use that. It's a poll.
Yeah.
It's just really, and yet we have to deal with that. Not only that, but rents take a very long time to rotate out because it's a 12-month lease. And so it takes a long time to see the actual decline in rents with 12-month leases because you have to wait for them to turn over. So there's just a lot of frustration in the housing industry over how the analytics are done for the cost of housing.
Mm-hmm. So
They'll
Grace
throw
asked,
Airbnbs in there too, by the way.
that just skews all the numbers. So Grace asked, where is Taiwan Semiconductor Company building their headquarters? So they're in North Peoria off of the I-17 and the 303.
Yes.
There's
and Amcor is down the street from them.
Right.
A new build. Yeah.
Right. And I mean, that whole area, I keep talking about that whole area is exploding. Mm-hmm. And it's going to change drastically.
Yeah. So regardless of what's happening here today in our marketplace now, the one thing that we can tell you is that the momentum of the greater Phoenix area economically is going to continue. It might slow down with the changes that we're seeing right now, but it most likely will not stop. And over time, we will be able to move past here. So whatever you purchase your home for today, a lot of people get really worked up and timing it exactly right. I have to be exactly at the bottom of the market or at the top of the market. The reality is, if you're going to hold it for 5 or 10 years, you're not going to care what you bought it for. Really.
You're just going to be glad you bought it.
Yeah. A few $1,000s here or there is not going to matter. You've refinanced since then. You've dropped your payment since then. Over time, that's why this is really, housing is typically supposed to be a long-term investment. And the people who have been hurt the most are those who are short-term holds, flip investors specifically get caught. If they don't watch the analytics real closely, they can get caught and get burned.
Yeah. And I mean, I know some flip investors that are still doing it right now and they're still doing well, but they also, I mean, they know their numbers and their margins so well that they will not, they just won't do it if the numbers don't work.
They shouldn't. They shouldn't do it, especially if you are in a market where the prices are trending down. That is not the time to be flipping a home. Mm-hmm. That is a time to be waiting or doing a long-term hold. But generally, flips only work in seller markets. And go ask Open Door. They lost $1 billion in 2022. So, and they are not doing very much. If you want to track flip investing, Open Door and OfferPad are still two corporations that still do that, but they are at the bare minimum, very, very little activity happening from those two companies right now.
Yeah. So John asked, I may have missed it, but what about Trump's recent remarks? Did he sign an EO?
You're going to have to be more specific.
No, I don't know. I'm sorry. I don't know. And then Bebop. I like your name, Bebop. Any thoughts on the FHA delinquency report from the Wall Street Journal?
Yes, I do. Frankly, FHA back in the crack cocaine seller market of 2021 and 2022, or even 2020, FHA has not actually been a heavy market share loan product. In fact, many FHA buyers were kicked to the curb along with VA buyers, mind you, during those years because sellers were like, I don't like their whatever it was. Right. The appraisal process, all these things that FHA requires, sellers didn't want to deal with. So a lot of those buyers, especially if they were low down payment assistance, they just weren't getting loans. So it was just been really within the last few years that we've seen people with FHA or down payment assistance actually being able to get in there because your corporate flip investing companies like Open Door and OfferPad are out. A lot of the Wall Street firms are out. A lot of the cash buyers are out. So these first-time home buyers are able to actually do that. But with FHA delinquencies, my question, and I don't have the answer to it, but back in 2023, the FHA offered a 40-year recast. Do you remember that, Sean?
Mm-hmm.
So if you were in distress and you had an FHA loan, they would literally recast your loan for 40 years, which would take whatever you owe today, recast it out as it was a new loan, and make it for 40 instead of 30 years and drop your payment. And so I'm curious to know how many people have taken advantage of that or not. And if
I don't know anybody that did
that or not.
Yeah. I don't know anybody that did. I don't know a ton. My business, I don't do a ton of FHA business, but I don't know anybody that did, but I'm sure there are people. I mean, that's huge. Adding 10 years.
The other thing that makes me sad, I don't know that I'm seeing a lot of FHA foreclosures. You might have FHA delinquencies. That doesn't necessarily mean that you're going to have a foreclosure. But all FHA loans are assumable. If you have an FHA loan that's 3%, 4%, 5%, you are at an advantage. You will find somebody who would be happy to assume that loan,
Right.
especially if you got it within the last couple of years, because that means you haven't paid it down too much. So they would have to have a good down payment, but not a lot of people would turn down assuming a 5% FHA loan. So my opinion on that is, if you are worried that FHA delinquencies are going to affect the market negatively, I'd say that could be mitigated by a lot of different things. So,
yeah. So John asked, I thought I heard Trump was working to reduce regulations for builders. I've heard that too. I don't know the extent, and I don't know where they are in that process. I'm not 100% sure about that. And then ADM Group, how does the FHA recast a loan if they are not the original mortgagee?
well, they would be. They would be the original mortgagee. That's only for the original mortgagee to recast a loan for FHA. But I'm saying that if somebody does not choose to recast their loan and they decide I'm in stress, I'm going to sell my place, and I have a low mortgage rate, you have an assumable mortgage. And in this area, a 5% assumable mortgage is golden. So I think they would be able to sell it and not go to foreclosure, is where I was going with that.
Yeah.
So still not seeing a whole lot.
Yeah. Bebop said, join late, and I may have missed this, but what do you think about the Fed tapering off MBS purchases?
They are not purchasing, by the way. They have not been purchasing. They've been selling.
Yeah.
So I think what you meant to say was, what do I think about them
selling off,
paring down on their release of their securities holdings? I'm excited about that. I'm trying not to get too much hope, because that's the first stage of disappointment these last 2.5 years, right? But the little thing that they said, because lately we've been in quantitative tightening. So the QT means that they are not buying mortgage-backed securities. They are actually selling them, or letting the ones they have mature and not replacing them, one of the two. And that actually keeps the supply of bonds high. And even though we have an increased demand for bonds, that consistent increase in the supply of bonds has been mitigating any relief we might see in the returns and the interest rates that those bonds are, offering. And of course, you guys know, I assume, since that was a pretty good question, that the 10-year treasury is linked to the 30-year mortgage. So oftentimes when we see that come down, we see the mortgage rates come down. So when they stated that they were going to pare down on their release of their securities holdings, then that means that they won't be adding to supply. They're not going to buy anymore for a while. They haven't been, but that at least allows the supply to start naturally doing what it's going to do, with potentially an increase in demand on the bond market from people moving out of stock market into bonds. And that could actually help us out on the mortgage rates indirectly.
So here's Jim Graham. Thank you, Jim, for looking this up for me. To the question about income for TSMC, their entry-level tech positions are around $75,000, and engineering roles in the semiconductor industry, according to Glassdoor, ranges from $80,000 to $150,000.
Right on. I was in the range.
I know. No, I mean, and that's what I've been told by most people, that they're not low-level jobs. They are,
right. Well, and somebody might argue, well, that's still not enough money to buy a house. But you know what? Most people buy homes with 2 incomes. Exactly. So times it by 2. Now you're in the money.
Right. So John says, with our current climate, would you still advise buyers to marry the house and date? I would never advise anybody to do that. I think a lot of recent buyers are getting seriously bit in the rear end by that following advice. I never have said that. Marry the house, date the rate. You've got to, even if you do a rate buy down, you have to know, worst case scenario, you're going to have to be okay with that higher interest rate, because it could happen, and it is happening right now. So I never told any of my buyers to do that. Marry the house, date the rate. I would always say, this could be a way for you to get into the house and save some money in the short term, and hopefully the rate comes down and then you can refinance into another, lower rate or something equivalent to it. But
I do not think they're getting bit in the rear. I'm just going to point that out right now. Anybody who got, depending on when they bought. So say, for instance, if they bought in 2022, at the end of 2022, they did pretty well. They've got appreciation in their home right now. And so at the end of 2022, their rate was 6.6%, something like that. So I wouldn't say that they've gotten bit in the butt. I would say they're probably disappointed. Yes. But my dog's whining. Sorry. In the back. It was funny. I said it was probably disappointed. And she goes,
right on cue.
I wasn't sure if that came through or not.
That's funny. It did. I heard it a little bit. Okay.
So anyway, no, they might be disappointed that they didn't get to, refinance and keep a lower rate that was offered to them by the seller. But reality is that in the late 2022, they've got appreciation right now. If they dated the rate a couple of years ago, the rate's the same. The rate's the same. They actually got a nice little benefit for 2 years. They got to relax. And they still have the opportunity to refinance if the rates were to dip at all right now. But over the course of the last few years, they have been paying themselves. If they had been renting, then they would have been paying somebody else's mortgage. And I can tell you that the tax deduction for buying, I'm going to throw it out there, most likely they're paying enough in interest to where it is worth a deduction on their tax return to where they could save a few $1,000s at the end of the year. And they have paid themselves back in equity on that property. So again, to lament what the monthly outlay is for your property that you purchased and feel like you got bit in the butt, I think they just haven't, that's an emotional response. That's not necessarily what the math is going to tell them long term.
Well, and that's the hard part, right? It's the emotions. But
that's just a disappointment. Like, I was hoping that, rates would come down. I could refinance and I wouldn't have to pay this 6.8% that I actually qualified for a couple of years ago.
But to your point about your niece, who is younger. I mean, if you're older, if you got a raise, it might've been more significant than what hers was.
I don't know. She did pretty well.
Oh, good. Good for her.
It's amazing how much your incomes go up in your 20s as
that's true. You don't
remember we went through that. Remember the quitting stages where people were quitting their jobs for better, better pay. That's not happening so much right now, but there is the analytics coming out of the Federal Reserve are showing that the wages have been growing faster than the rate of inflation for some time.
So how does that work? The FHA is the original mortgagee, but the DOT and the PN note state other financial entity.
They have an FHA loan. It is 100%. If it's an FHA, it's assumable loan. That's all. I don't know about any of that other stuff. Yeah. I mean, I'm not going to go like diving deep into it, but there are companies out there that Sean can refer you to for more, apparently a really good next show can be on that.
Right. So does the Cromford Report purchase data from Armless, or does it is it publicly available, or does it publicly available data sets from the county recorder's office, or both? Sorry.
Okay, so the Cromford Report we have a data license with the MLS that allows us, which we do pay for. We are entrusted with that. We download it every single day. And in return, we are only allowed to sell subscriptions to our data to real estate agent members of the Arizona Regional MLS. So we sell it back to Sean, but we do work for it.
Oh my gosh.
She puts it in, we sell it back to her. But and we also do get public record data from the county recorder's office that helps us.
But that's the thing I think to know too with this Cromford Report is that it's available to all real estate agents, but you have to pay for it. And not all real estate agents have it. What's that? What do you have? What's the percentage?
Oh gosh. I don't have the percentage of total agents. The last time I did a little analysis, in order for somebody to actually pay for our stuff, which is $35 a month, it's not like it's a lot, but usually for somebody to feel it's worth it to pay for a subscription, they need to be doing at least 6 deals a year. Right. And when we did that, analysis, there were probably only about 4,000 to 6,000 agents that actually did enough to warrant buying the Cromford Report. And so out of that, we had about a 30 to 50% market share.
And I'm geeky enough that I pay for the next level so that I can get the other information too.
Yeah. Yeah. And so, and on the public record side, which is we call it Cromford Public, which is available to the public as well, because it's from the Maricopa County and Pinal County Recorder's Office. That's $240 a year. And we have plenty of lenders and other industry professionals that subscribe to that too.
I'm gonna skip down here because Bebop says hiring data engineers.
We are a little company.
They are a little company.
We work for free.
They're small but mighty, I'll tell you. Grace said, if you assume the loan from the FHA mortgage, does that make you a new original mortgagee?
Yeah, it's a new loan.
Yeah.
Because
it's assumable.
Yes, and the original borrower is novated from the loan, so they're
right.
No
It's not like the subject to stuff that a lot of people are talking about right now. It's not the same.
It's much better. It's much better, much safer for everybody involved.
Yeah. Well, Tina.
Well, we really did the gamut on topics.
I know. This is I love it. This is what he says. No, it makes you a new mortgager. Right.
Yeah, exactly.
Right. Bebop, you both are awesome. Best Phoenix real estate. Oh, thank you very much. Makes me happy. Thank you, Tina. You're amazing.
Thank you so much. Thank you for your support, Sean. We've been friends a long time. We've learned a lot from each other.
Yeah, I've been friends for a long time. I appreciate it. I thank you very much. And you guys have a great weekend. See you next week. Bye.